If you are losing sleep trying to decide between VOO and VTI for your 2026 portfolio, stop. You are falling into the perfect choice trap. It is the most common anxiety I see in new investors. The fear that picking the wrong ticker symbol will cost you millions in retirement. The truth? These two funds are 82% identical. They are basically twin brothers. But that remaining 18%, that tiny sliver of difference is where the real debate is. And surprisingly, the difference has almost nothing to do with math and everything to do with your psychology. Today, we are entering the cage match, the elites, VOO versus the entire haystack, VTI. We aren't just looking at past returns, we are going to look under the hood to see how the engine actually works. By the end of this video, you will know exactly which one fits your personality and why picking the wrong one might actually cost you absolutely nothing. Part 1. The composition, the fruit basket. Meet VOO, Vanguard S&P 500 ETF. Think of this as the VIP club of investing. It tracks the S&P 500, meaning it only lets in the 500 biggest, most dominant companies in America. Then there is VTI, Vanguard Total Stock Market ETF. Think of this as the whole enchilada. It tracks the total stock market, meaning it owns those same 500 giants, plus over 3,000 smaller companies that VOO ignores. Let's strip these funds naked and see what is actually inside. This is where the confusion starts. First, we have VOO. This tracks the S&P 500. Imagine a basket with the 500 biggest, ripest, most expensive apples in the US market. We are talking Apple, Microsoft, Nvidia, Amazon, Google. These are the giants, the companies that practically run the world. When you buy VOO, you are betting on the established winners. Then we have VTI. It tracks the total US stock market. Now, people hear total market and they assume it's completely different. But look closely at the basket. The top of the VTI basket is the exact same 500 apples found in VOO. VTI owns everything VOO owns. But VTI doesn't stop there. It also throws in over 3,000 mid-cap and small-cap companies. These are the tiny green grapes underneath the big apples, the up-and-comers, the risky bets, the companies you've probably never heard of. So the fundamental choice seems to be, do you want just the best of the best, VOO, or do you want absolutely everything, VTI? On the surface, VTI looks superior. It looks more diversified. Logic tells you that owning 3,700 companies is safer than owning 500. If one giant fails, you have thousands of backups, right? Well, that brings us to the biggest illusion in investing, the gravity problem. Part 2. The gravity problem. Cap weighting. This is the invisible mechanic that 90% of YouTube videos skip. They tell you VTI is more diversified, but they don't explain how the math works. The stock market is not a democracy. It is a plutocracy. Size matters. Both VOO and VTI are market cap weighted. This means the bigger the company, the more of your money goes into it. Think of the US stock market like a giant pizza. The Magnificent Seven tech stocks, Apple, Microsoft, Nvidia, etc., make up a massive slice of that pizza. In VOO, the top 10 companies make up roughly 30% to 35% of the entire fund. In VTI, those same top 10 companies make up roughly 28% to 33% of the fund. Do you see what just happened? Even though VTI holds 3,000 extra companies, those companies are so small that they are just crumbs on the pizza crust. For every $100 you invest in VTI, about $82 goes into the exact same large cap companies that are in VOO. Only about $18 gets sprinkled across those thousands of small caps. This is the gravity problem. The giant companies are so heavy, they pull the entire market with them. If Apple and Microsoft crash, VTI crashes too. Those 3,000 small companies aren't big enough to save you. They are just along for the ride. So if the composition is so similar, why do people fight so fiercely over them? Because of the small cap dream. Part 3. The small cap dream versus reality. The argument for VTI usually sounds like this. Small companies have more room to grow than big companies. Amazon can't double in price as easily as a tiny startup can. This is technically true. Historically, there is something called the small cap premium. Over extremely long periods, we are talking 50 or 100 years, smaller stocks have tended to outperform larger ones because they are riskier. Investors demand more return for taking that risk. So, VTI fans argue that by including those 3,000 small stocks, you are catching the next Amazon before it becomes Amazon. You are buying a lottery ticket that VOO doesn't have. But here is the reality check. Because of the weighting we just talked about, for VTI to significantly beat VOO, those small caps don't just need to do well, they need to explode. Let's look at the actual scorecard. I looked at the data from the last decade. If you put $10,000 into VOO 10 years ago, you would have a massive pile of cash today. If you put $10,000 into VTI 10 years ago, you would have almost the exact same pile of cash. The difference is often less than 0.5% per year. Why? Because while some small companies exploded, many went bankrupt. VOO avoids the bankruptcies by only holding the winners. VTI catches the winners early, but also drags the losers. It cancels out. Part 4. The hidden dangers, volatility, and dividends. So far, it sounds like a tie, but we need to talk about the pain tolerance factor. When the market crashes, and it will, VOO and VTI react slightly differently. Historically, in a major panic, small companies get crushed harder than big companies. When investors get scared, they flee to safety. They sell their risky small stocks and keep their blue-chip giants. This means that during a crash, VTI might drop slightly more than VOO. We are splitting hairs here. Maybe VOO drops 33% and VTI drops 34%. But for some investors, that extra volatility is annoying. On the flip side, let's talk about dividends. If you are looking for income, who wins? Generally, VOO has a slightly higher dividend yield than VTI. Why? Because large established companies like Coke or Chevron like to pay dividends. Tiny growing companies prefer to reinvest their money to grow. So, if you are strictly looking for cash flow, VOO often edges out VTI by a tiny margin. But again, we are talking about pennies on the dollar. Part 5. The psychological advantage. The FOMO factor. If the math is identical and the returns are identical, how do you actually choose? This is the most important part of the video. The decision isn't financial, it's behavioral. The biggest danger to your wealth isn't picking the wrong ETF. It's tinkering with your portfolio. It's selling when you should be holding. VTI has one massive psychological advantage over VOO. It cures FOMO, fear of missing out. Imagine this scenario. It's 2026. Suddenly, a tiny biotech company discovers a cure for baldness. Its stock goes up 1,000% in a week. Everyone on the news is talking about it. If you own VOO, you check your list. That company isn't in the S&P 500 yet. You missed it. You feel regret. You might be tempted to sell your VOO and chase that hot stock. That is a mistake. If you own VTI, you check your list. You own it. Sure, you only own a tiny piece of it, but you technically own it. You caught the rally. You feel smart. You do nothing. You keep holding. This is the superpower of VTI. It allows you to say, I own everything. It stops you from chasing shiny objects because you already own the shiny objects. If you are the type of person who gets jealous when other stocks rally, VTI is your insurance policy against your own brain. Part 6. The verdict. What should you do? So, here is your 2026 roadmap. If you are a minimalist who wants the absolute simplest path, pick VTI. You own the entire haystack. You never have to read a financial news headline again because whatever happens in the US economy, you own it. You get the large caps, the mid caps, and the small caps. It is the ultimate set it and forget it. If you are a quality purist who only wants the best, pick VOO. You are sticking with the proven winners. You filter out the junk. You get slightly less volatility during crashes and slightly higher dividends. It is the standard for a reason. But what if you already have one and want to switch? Don't. Switching creates a taxable event. If you sell VOO to buy VTI, You have to pay taxes on your gains. That tax bill will destroy more wealth than the difference between these two funds ever will. If you have VOO, keep buying VOO. If you have VTI, keep buying VTI. If you have both, honestly, that's fine too. It's a little redundant, but it's not hurting you. The only way you lose this battle is if you sit on the sidelines in cash, paralyzed by the choice. The best time to pick one was 10 years ago. The second best time is today. Pick one, automate it, and go enjoy your life. If you learned something new today, please like and subscribe. It really helps the channel grow. Thanks for watching, and I'll see you in the next one.